Three quality stocks to buy near their 52-week low. This is a video that I've been doing every Saturday, and you guys have enjoyed it very much. When I go on any screener and I go on Fiscal.AI, I just write on the bot and I put in stocks to buy within 10% of their 52-week low. I click run on the screener, and I get all the stocks within their lows, and I analyze three highly requested, high-quality companies, and I let you guys know my opinion on them, if I believe they're undervalued, if I believe they're overvalued, and give you an update on them in general. So if you do enjoy it and if you want more of those videos, please let me know down in the comments below. The first one, which is a stock that I haven't talked about in a while, and I've been asked so many times, please give us an update on UNH. And I normally don't like to give updates on stocks before earnings because most of the things between earnings is mostly noise. So I tend to focus on the earnings report. But for UNH, a lot of things did happen. It's a dramatic stock. One of the craziest stocks I've been involved in. It's down 50% over the last year. And this is one of the stocks that I bought, and it did not go straight up. It just went straight down. And this is how it is sometimes in the market. I think some investors have unrealistic expectations where they're trying to be perfect. They're kicking themselves because they bought UNH 2 months ago or 4 weeks ago and the stock went down. But the truth is, guys, not every stock you're gonna buy is gonna go straight up. Some stocks, they go a little bit lower, then they eventually go higher. And that's just the way this game works. So you have to have some kind of a longer term horizon, more than a month or 2 or 3 or 4 months. So to me, it's always crazy whenever I see comments, like my video did not age well, even though my video on UNH is like 5 weeks old. I'm like, if your horizon is only 5 weeks, then good luck investing, especially in the bear market. But very recently, something else has happened with UNH, where UNH has finally confirmed the report that the Wall Street Journal has put up initially, which was mainly around them having some kind of an investigation from the DOJ. And they said that the company has started complying with formal criminal and civil requests from the DOJ. United Health also said it has launched a third-party review of its business policies and performance metrics. So this is really, really bad. But it's not the first time a company like that had some kind of involvement with certain investigations or certain lawsuits. And they have an independent audits by the Centers of Medicare and Medicaid Services, and they confirm that the company's practices are amongst the most accurate in the industry. So to me, this is very interesting. And UNH has also pointed out to a special master's recommendation in March in favor of the company in a years-long battle with the DOJ that began with a whistleblower who alleged the company illegally withheld at least $2 billion through the Medicare Advantage program. So this is, again, guys, not the first time UNH faces some kind of a major lawsuit, some kind of a major event. Now it's getting more attention than other times, and the stock is going down more than it did previous times. But every few years, those companies are hated. They're gonna face some kind of investigations. Most of the investigations on UNH has never stuck because they had very good practices and a lot of third-party audits. And then the drama is over and the stock recovers and people say they wish they bought more. That's normally how it ended up working over the last 20 years. Maybe this time is different, but again, I would not be too worried about this because it's not the first time it happens. And it happened to many different companies where the stock goes down and people believe that the stock is dead, the company is dead, it's never gonna recover, and all these kind of things. And out of nowhere, the stock recovers, kind of like, BTI, British American Tobacco, one of the most hated stocks ever that I talked about. It's up 48% in 1 year. 48%. This is insane. Why do those stocks even move in certain ways? Not just because there was some kind of investigation or some kind of legal troubles that were over, but this is because the stock has priced in the worst. So many investors, they focus too much on the news and too little on the valuation of the company and how much is already priced in. Because companies in general, they don't bottom on good news. So a lot of people are waiting for good news to buy stocks. They waited in 2022 for good news to buy stocks. Maybe they're still waiting because we had a lot of bad news in October and we had 95% of analysts expecting a recession. Yet this is when we bottomed. Why? Because we priced it in. when no one was expecting it to. Now, very few people are expecting UNH to have potentially bottomed or have the potential to even recover. So, and they're giving up on it. I'm seeing a lot of capitulation. But at 13 times earnings, to me, I believe a lot of those things are priced in. Now, those earnings could be a little bit different because they're going to issue guidance the next quarter, which is in, I believe, 7 days. And if it's a new CEO, he normally lowballs guidance so he could beat. So we might have one final dip. But based on what I've seen with many of those stocks, they bottom on bad news. Tesla bottomed when they missed deliveries. McDonald's bottomed whenever they had their first quarterly decline in same-store sales since 2013. I owned the stock. The stock went up 7% in 2 days. Why? Because it was going down like 30% in anticipation of this report being bad. And it's the same thing with UNH. UNH is down 48% in anticipation of a bad report. So as long as the report is not as bad as expected, UNH stock will likely start to reverse and it should start doing really, really well in my personal opinion. And if you look at it, 13 times earnings, and the company has grown 15, 16, 17% earnings per share. And the CEO said that his long-term target is still 13 to 15% earnings per share growth. So to me, this is an amazing value proposition with what people used to call a recession-proof blue chip stock just 10 months ago. But now it's hated and no one wants to stock anymore. So to me, it's starting to look very, very interesting. And by the way, I'm using Fiscal.AI to come up with the charts and the screener and everything. So if you want to try it out, they give you free access if you use my link down into the description. Now, this is the second stock, which a lot of people have asked me about, and I'm going to talk about it again. And this is Lululemon. Lululemon is down 41% year to date. This is a very popular brand, great brand. It went viral on TikTok a few years ago, and many people are still buying the brand, and the stock is down 42%. Now, they reported earnings not long ago, and they said that they pretty much cut their full year guidance, citing a dynamic macro environment. And they said they're not happy with US growth, and they said US consumers are being cautious and intentional about their buying decisions. Now, whenever you see those two headlines that they cut their outlook and they did all those things and the stock went down, you would expect like some kind of a major cut in outlook, right? But that wasn't the case with UNH. They cut their outlook from 1495 to 1515 down to 1458 to 1478. So they cut it by like 40 cents. But the market freaked out, the stock freaked out, I believe because of the comments that the CEO has made. But the main reason why I should say Lululemon is going down in general is because this company is facing one of the worst things that a growth stock could face, and this is peaking growth. The company has peaked in growth. They were growing 30% to 28% in 2022, 2023. Now it went from 24, 18, 15, 10 to even 7%, and is expected to grow 7% this quarter and 7% on the next. So from 30% growth to 7% growth is a big difference. Now, if we look at the internals of the company, United States is very weak. Only 3% in the United States. International is 19%. Now, the biggest risk with investing with Lululemon is it really depends on what I would call those kind of trends. So Lululemon went trendy like a few years ago on TikTok and everyone loved it. Now you have people talk about some kind of aloe, whatever, clothing or whatever it is. And then some kind of other, maybe Shein brand or some kind of brand that's cheaper could go viral on TikTok or viral on Instagram, and everyone else wants the same kind of clothes. They all copy each other's, and all of a sudden Lululemon isn't as trendy anymore. So this is a problem that the fashion industry faces, which is why I don't like to touch them, is you don't know when a new trend emerges with something weird, like even Crocs emerged as a trend in 2020, and the stock boomed in sales. It went up like 800%. And then it went back down. So you don't know for how long the trend will last. And if you don't know if those customers will remain loyal to the brand, or will they be open to trying something new because it's trendy. if you know what I'm trying to say. So this is the biggest risk with investing with Lululemon and investing in many of those companies is the trend, and you don't know for how long it's gonna last. But if I look at the company's P/E ratio, it's trading around 14 times earnings. This is insane. It used to trade at 75 times earnings, and now it's as low as 14.9 times with an average of 35. So I believe a lot of the bad, again, is priced in a stock like Lululemon. Lululemon's growth is very hard to predict. They grow 82% earnings per share, and they grow 19s, and they decline, and it's all over. But it's expected to be like 5.7% next year, and pretty much flat to low single digits. But for 14 times earnings for such business, they have a good balance sheet, very good capital allocators, and very little debt, and it's a good company in general. High margins in terms of net income margins, high return on capital. So 14 times earnings is not expensive at all. But what I worry about is what I told you guys in terms of the trend. So if Lululemon is not trendy anymore, they get excited about something else. Will they still be alive, or will they get acquired, or will they plunge in sales like never before? You really never know. So this is the biggest risk with Lululemon. The third one, which is a very interesting one, is MSCI. MSCI is the classic kind of stock that I like to showcase on why I tell people don't overpay for quality. MSCI is an amazing high quality company, but it's still pretty much flat since 2021. So if you bought MSCI in 2021, you had 4 years of no returns. Imagine what Nvidia did in 4 years, what Google and Meta did in 4 years. MSCI is still flat, despite the company being a high quality company. Now, why is it flat? Because the stock was extremely overvalued. The stock was trading as high as like 65 times earnings. Now it's trading at 30 times earnings. So it got cut in half in terms of a multiple. And this is, again, another example where even though it's a high quality company, not every stock will command a Costco multiple and sustain it. So if you overpay for that quality company, you could still lose money. But with MSCI, it's, again, an amazing business. Most of it is recurring revenue business model, high organic growth all over the world. It's really an amazing business. Most of their money come from the MSCI index. It grows 12% organic. It's bulletproof. It's never going away. I'm sure you've seen many MSCI ETFs and MSCI indices. So this is, again, an amazing business model. Then they have the analytical business or analytics business, which is also growing 8%. Now, what surprised me is their ESG business, which is sustainability and climate. I believe this is where they give certain ratings or something around like ESG investments. And I was thinking that it would decline with the rise of the new administration because they're against sustainability and climate in terms of investments. But it's actually growing 11% year on year. So to me, this is, again, it's very interesting. And all the parts of the business are still growing. And same thing with private assets and other things that are also growing 8% and 6% organic. So everything is pretty much going so well. It's one of the best business models you could ever own. Amazing company. I told you the multiple has gone down from like 68 times to 30 times earnings. Now, 30 times earnings, to be honest, is really not expensive at all for a company that has 40% net income margins, very high net income margins, very little expenses, and they're growing very well in earnings per share. This year is going to expect to grow 21%, next year 12%. So you're getting on average, if you want to look on an average, which should sustain, I believe, is around 15% in earnings per share growth for 40% net income margin, and you're paying 30 times earnings, which is really lower than the average multiple. It's as low as what it traded at in like March 2020 or 2019. To me, MSCI over here is actually not bad at all. I mean, I want to hate on the company, and I used to hate on it, but I think the fundamentals and earnings per share are starting to catch up to the high valuation. And I think MSCI, for someone that's conservative, buy and hold forever, likes some kind of quality companies with some kind of a moat or efficient business, I think MSCI is looking very good. And to me, I have it on my screener actually, on my watch list, and I watch the stock. And to me, it's looking very interesting. It's not going to give you life changing returns, but I can see 14, 15, 16% a year without a multiple expansion. And with something like MSCI that's still growing very well organically on all fronts, to me, this is amazing. It's really amazing. So I like MSCI. Lululemon, again, I'm not sure about that trend of decelerating growth and other, brands emerging. We don't know where the multiple is gonna bottom, and we don't know how sustainable it's gonna be. UNH, I'm gonna do another update on earnings and let you guys know my thoughts on everything. So that's just my opinion on those stocks. Hope you enjoyed it. Not financial advice. If you do enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.